the sound of the alarm, the same sound every morning. And as you press that little button in a daze, have you ever wondered how many more years this ritual will go on? Most people don't wonder about this. Retirement always seems like a distant possibility to them, maybe at 60, maybe at 70, an uncertain dream they put off saying, we'll see when the time comes. But today I won't be telling you a story. I'll be talking about math because math doesn't lie, emotions lie, the news lies, but the compound interest curve never lies. By the end of this video, you'll fully understand just how powerful a tool 5 years can be. I call this the 235 Freedom Plan. It involves spending 2 years laying the foundation, then gaining momentum in the second or fifth year. That is, at the turning point to reach the stage where your money starts working for you and waking up early is no longer a necessity but a choice. Of course, first you need to understand this. This plan isn't a miracle. I'm not suggesting something like a lottery ticket. What I mean is, when applied systematically, the results are almost inevitable. You'll see the difference between your old self and your new self. But pay very close attention to the word almost, because the market isn't this plan's only enemy. Your only enemy might be yourself. Now, let's move on to phase 1. The first 2 years are crucial. You need to pay attention to this because the first turning point. You need to wake up. And let me say this up front. These are invisible years. You're investing, but your account balance looks pitifully small. You stop going out, avoid unnecessary expenses, quietly simplify your life, and when you look at your balance, it seems like nothing has changed. You start to feel like the universe is deliberately ignoring you. Let me give you a concrete example to make this clearer. You're investing $200 a month in a broad-based, diversified fund that yields an average annual return of 9%. At the end of the first year, you check your account. Maybe there's a few $100s in profit. Have you ever wondered if that's all you get in return for all that sacrifice? This is a critical moment. Compound interest doesn't reward you right away. It tests you and measures your patience. It tests whether you'll continue to contribute to the system or not, even when you experience emotional disappointment. As you approach the end of the second year, small shifts begin to occur. The small profits you earned in the first year now start generating their own profits. A powerful partner joins your contributions, your previous gains. From that point on, the curve begins to curve upward, not just slightly, but distinctly. This is the moment when you see with your own eyes for the first time that money isn't working against you, it's working with you. And that mental shift changes everything. You no longer wonder whether compound interest actually works. You know it does. And once you truly know something, you can never go back to not knowing it. So why 2 years specifically? Why not 5 or 10 years, but exactly 2? Because compound interest needs enough time to start yielding its first returns, but it's also essential that a tangible reward appears before you lose motivation. That's why 2 years is the critical point where discipline and concrete results intersect. And by the end of those 2 years, something far more important than math happens. Your identity changes. You're no longer just someone waiting for a paycheck. You're becoming an investor. Skipping a month bothers you. You shift from asking, do I have enough to invest? To, how much can I afford to lose? This shift in identity keeps you in the game. Math is powerful, but the shift in identity is more powerful than math, because math can't protect you, but it can protect your sense of who you are. Now for the second phase, the next 3 years, the second turning point, momentum. The snowball is no longer a cute little ball. It's a heavy mass rolling down a steep slope. You're still contributing, but a new dynamic has kicked in. The returns in the third year begin to rival the total of what you earned in the first 2 years. Every dollar of profit is now like a little worker who never sleeps, never asks for a raise, and never takes a vacation. If your portfolio previously generated $500 in profit, that $500 is now growing at the same rate as your actual contributions. Most people think in terms of addition. I invest $200, so I get $200 richer. They say, that's linear thinking. In the acceleration phase, every additional $200 hires more workers. Over time, the workers earn more than the boss. That's the power of compounding. When you check your account in the third or fourth year, you'll notice something strange. The 12-month balance growth exceeds all the investments you made that year. Slowly and steadily, your earnings begin to outpace your labor. You get the feeling you've discovered a secret shortcut. That's how simple the truth is. That's what compound interest looks like after enough time has passed. It rewards patience, not intelligence. There's no strategy as brilliant as staying in the game. And this is exactly where many people sabotage themselves. They see their balance reach $10,000 or $15,000, get frustrated, and hit the button. They make a purchase that erodes everything they've saved over the years. It's like shutting off the engine of a plane that's accelerating down the runway. All the fuel you burned during those invisible years was meant to get you airborne. You give up just as the wheels are about to leave the ground. If you stick with it, the wheels gain speed. As the snowball rolls, it gathers more snow. By the end of the fourth year, the money earned in a single year could exceed the total earned in the first 2 years combined. The numbers vary depending on returns, but the pattern holds. Gains gain momentum. And now you should start focusing not on how much you've invested, but on how quickly your money is growing. Emotionally, this stage feels like a quiet excitement. You're still living simply, but now you understand what the trade-off means. Every unnecessary expense isn't just an immediate cost, it also means you're erasing future growth before it even happens. That's why you start protecting your investments as if they were living things. Because in a way, they are. They're multiplying. You and your money are finally on the same team. Now, we're moving on to the third phase, the 5th year and beyond. The third turning point is the explosion. This is the moment when the curve, which had seemed almost flat, suddenly shoots upward like a rocket launch. That's what we call the explosion. The growth in a single 12-month period can exceed the total gains the portfolio made over the previous few years. The strategy hasn't changed, but the momentum has. Your monthly growth can now rival your weekly paycheck. Eventually, your annual growth can cover your living expenses. That's when retirement stops being a fantasy and becomes a real decision you can make. And at this point, the concept of freedom number can become critical. Set aside the generic millionaire goal. Freedom isn't a specific wealth figure. It's about investing enough to reach the point where your passive income quietly funds your lifestyle. For some, that's $40,000 a year. For others, 60. For others, 80. The number doesn't matter. The principle does. When your investments cover your living expenses, you've broken the chain. Think of this stage as reaching critical mass. In physics, critical mass is the point at which a reaction becomes self-sustaining. In financial terms, it's the moment when reinvested profits reach a threshold where the compound interest mechanism begins to work almost automatically. The rocket analogy fits perfectly. The hardest part is the launch. Most of the fuel is used in the first few minutes to escape gravity. Years of obscurity and disciplined training were your fuel. Now you're in orbit. Here's what this stage feels like in everyday life. You don't feel the need to check your bank balance before going to the grocery store. You don't worry about every bill. Losing your job isn't an emergency. It becomes a mere inconvenience because your portfolio is already providing for you. Freedom isn't about being able to buy everything. It's about no longer needing everything. Now let me explain how to actually get started with this plan. Step 1. Set a realistic monthly amount you can commit to without shaking the foundations of your life. It could be $50, it could be $500. The number is far less important than the commitment. Small but consistent always beats big but sporadic. Step 2. Choose a diversified, compound growth investment vehicle that aligns with your risk tolerance. For many people, this means combining broad market index funds with dividend-paying assets. The key is simplicity, not following the latest trends on social media. Step 3. Automate everything. Set up an automatic transfer right after payday so you don't see the money sitting in your checking account. Automation protects you from your own moods and impulses. It turns discipline from an exception into the default. Step 4. Starting today, write down a date exactly 5 years from now. This is your breakthrough horizon. You are not allowed to evaluate the success of your plan until that date. You can make adjustments, but you cannot abandon the plan because of short-term emotions. Every contribution you make is a small step taken for your future self. With hundreds of small steps piling up, the future becomes almost inevitable. What about doubts? Market downturns, terrifying headlines, voices predicting disaster every week. If you let those voices control you, unfortunately, you'll be prone to disrupting the very process that protects you. Volatility isn't your enemy. For a long-term investor, volatility is merely the cost of entry. It's a noise surrounding the signal. The real enemy is abandoning the plan, selling at the bottom, stopping contributions when everything looks bleak, or constantly changing strategies because you're bored. Math is powerful, but it can't help someone who keeps starting over. And here's another truth that no one talks about enough. The advantage of starting early is often stronger than the advantage of starting with a large amount. Someone who starts a year after you might be contributing twice as much, yet still fall behind in the long run. Because you had an extra year for your money to compound. Consistent intensity wins out. Time spent in the market is always superior to trying to time the market. Ask yourself honestly, where do you want to be in 5 years? Do you want to be someone who wakes up to the same alarm and complains about the same job? Or do you want to be at a point where work has become optional and your investments quietly fund your life? Picture that scene in your mind in the morning. The alarm isn't ringing. You're happily making yourself a cup of coffee. You look at your portfolio not with anxiety, but with curiosity. You plan your day not according to someone else's schedule, but based on what matters most to you. But don't forget this. This is no guarantee. Life goes on, markets fluctuate, and returns change. What you can control is your behavior. Save regularly, invest wisely, diversify, and keep your expectations realistic. A plan only works if you commit time and honesty to it. Depending on where you live, taxes and regulations will affect your journey. Find out how dividends and capital gains are taxed in your situation. Plan ahead to prevent inflation from quietly eroding the financial freedom your portfolio is working to build. In 5 years, you'll either be glad you started or wish you had. Today, you're choosing one of those two options. This video is for educational purposes only and does not constitute financial, investment, or legal advice.